Continuing topic 4, we now move on to subsidiary legislation, and specifically 6 sets of rules that are listed on 4.9, page 4.9. You'll see at the bottom, yes, we have the insurance rules, a 7th, but we don't spend too much time on those. We have the financial resource rules, client security rules, client money rules, keeping a record rules, contract notes rules, and accounts and audit rules. Now, these are all subsidiary legislation. What does that mean? It means that they've been written by the SFC and passed by the government, but they have the power of law, the law behind them. So if you breach any of these rules, you are committing an offence and you can be prosecuted. Now, who do they apply to? Well, this table on page 4.9 makes it very clear. They all apply to licensed corporations, which is not surprising because the rules are written by the SFC and the SFC directly supervises licensed corporations. So it makes sense that the rules apply to all corporations. What about registered institutions? Now remember, registered institutions directly supervised by the Hong Kong Monetary Authority, and they're registered to carry out SFC regulated activities. Well, the rules that do not apply to registered institutions are in areas where the HKMA take a role. Anything to do with money. So you will see the financial resource rules do not apply to registered institutions. Client money rules do not apply to registered institutions. And accounts and audit rules, well, they're fairly sensitive. No, they don't apply to registered institutions because the HKMA has their own requirements for financial resources, for client money, and for accounts and audit. But the other rules do apply to registered institutions. And then with associated entities, it depends on whether you're dealing with an AFI or not. I wouldn't worry about the rule applicability to associated entities. I would be aware of the rules that don't apply to registered institutions. So we are going to go through these rules and pick out the major learning points. Now, are the rules examined? Yes. The rules that are almost guaranteed to be examined are the financial resource rules, client security rules, and the client money rules. The other rules may or may not be, but the first 3 are regulars in the exam. Now, moving on to page 4.10, we're going to be looking at the financial resource rules. And at the outset, we see there's a need for capital requirements in the licensing regime. The SFC is neurotic about making sure that the licensed corporations have sufficient capital to trade, to do business. What they do not want is any licensed corporation going bust, to put it bluntly, because then you've got systemic risk. Other corporations, other intermediaries may experience financial difficulties, a domino effect. Last 2 bullet points under 2.1, minimum capital levels required by registered institutions set by the HKMA, not the SFC, and minimum capital levels required by licensed corporations set by the financial resources rules, which is what we're going to move on to. Now, all of this material I've seen questions on. The financial resource rules themselves, well, the liquidity of a corporation will be reported on the balance sheet. The bullet point there says that the licensed corporation must have adequate amount of liquid assets to meet its liabilities. And because the SFC considers the balance sheet, they expect the balance sheet to be made up following specific accounting bases. And there are the 4 listed. Are they examined? Never used to be, but just recently we haven't seen a question popping up examining those 4 points, so be aware of them. So how do I calculate liquid capital? Well, there it is at the bottom of page 4.10. Our liquid capital is equal to liquid assets minus ranking liabilities. Now, in the liquid capital box, we are told that the liquid capital must be greater than RLC at all times. That is required liquid capital. What is the required liquid capital? What level? Well, at paper 1, we do not need to know. At paper 2, paper 6, etc., the responsible officer papers, yes, you need to be aware of the levels, but at paper 1, we just need to know that licensed corporations, their liquid capital must be greater than the required liquid capital, whatever that is at all at all times. And the liquid assets, all assets after certain haircuts, yes, examples are given. And ranking liabilities, total liabilities less approved deductibles. What about paid up share capital? Do they have requirements? If you hold client assets, yes. And the paid up share capital ranges between 5 million and 30 million. Again, at paper 1, we don't have to worry about that detail. But I would be aware of those who do not have paid up capital requirements. And in the sub-bullet point, we're told, approved introducing agents, securities advisors, corporate finance advisors, asset management, credit rating agencies. What they all have in common is they do not hold client assets. In that case, they do not have any paid up capital requirements. Now, under the financial resource rules, you are expected to notify the SFC in particular situations. It's sort of early warning system. They tell us licensed corporation unable to comply with capital requirements must notify the SFC in writing as soon as practicable, cease conducting regulated activity immediately unless SFC does permit to continue. That's very important and often examined. So if you dip below the required liquid capital, cease trading, inform the SFC in writing as soon as practicable. Also, the SFC expect you to communicate in writing if liquid capital falls below 120% of required liquid capital, and that's a buffer. Now, you can continue trading, but the SFC wants to know if you go below 120%. It's an early warning system. If the liquid capital falls below 50% of the last liquid capital reported, again, you may be above the required liquid capital, but they still want to know because that's indicative of potential liquidity problem. And if information submitted in earlier return becomes materially false or misleading, so information you gave earlier no longer applies, they expect you to notify in writing. Now, returns to the SFC, liquidity returns, it all depends on whether or not you hold client assets. If you do, the first point applies. If you hold client assets, you are required to make monthly returns of liquid capital to the SFC. If you do not hold client assets, the second point kicks in, then you need only make a return half yearly containing financial statements, etc. And under the financial resource rules, the SFC can give approvals, and they're listed there. The main one that may come up in the exam is the approval of introducing agents, approved introducing agents, and we will cover those later in the material. Let's move on to client securities requirements. And here we're going to consider client securities rules and client money rules. And in general, we see a couple of points at the top, part 3.1. I'll let you read through those. Now, the client securities rules are designed to protect client securities that are held by the intermediary. In other words, they're not held in the client's name, they're in the intermediary's name. They're held on behalf of the client. And these rules intend to ring fence these securities to protect them from any unscrupulous behavior by the intermediary. If suddenly there's pressure on liquidity, temptation to sell securities that don't belong, well, this legislation is designed to protect those securities. Now, what are the securities that these rules apply to? And this has been examined under the assets. Client security rules apply to client securities or securities collateral of an intermediary that are listed on a recognized stock market, that is Stock Exchange of Hong Kong. Interest in authorized collective investment scheme. Now, collective investment scheme is like a mutual fund, a unit trust. And if you make those schemes available to the public, the retail investors, they must be authorized by the SFC. So interests in these products are covered by the client securities rules. And then they must be held by an intermediary in Hong Kong in the course of conducting regulated activities. So I've summarized that with the next bullet point. The client securities rules do not apply to securities held by an intermediary in an account in a client's name. Actually, the summary is right at the bottom. I beg your pardon. This point is to do with being held in an account in a client's name. If that's the case, the rules don't apply because there isn't the risk. The securities are in a client account. So it's the summary is in the italics at the bottom. Rules only apply to Hong Kong stocks held in Hong Kong, received by an intermediary or societe in the course of conducting regulated activities. And the point of securities being held overseas and not being covered by the client securities rules is a favourite in the exam. So be aware, for the client securities rules to apply, the client securities must be held in Hong Kong. If they're overseas, these rules do not apply. Client securities rules also introduce the concept of a standing authority, like a standing order. That is a written notice authorizing intermediary or the associate entity to deal with client assets in ways specified. And we give details of how long such an authority can last for and the renewal requirements. Then we have 3.2.2, treatment of client securities and collateral, that is keeping the assets safe. Now, some of these points, yeah, you can read through them. The major point, as far as I'm concerned, of the client securities rules is under depositing or registration of client assets. The second bullet point, sub-bullet point, says any deposits must be in separate, segregated accounts for each category designated as trust or client accounts. So that is one of the main points, is that if you hold client securities, they must be kept in separate, segregated accounts. They cannot be held in your own firm's account. Bottom of 4.13, dealings with client securities and collateral. There are three basic authorities: an oral or written direction, sell or settle, a written direction, and a standing authority. The standing authority we saw introduced at the top of page 4.13. And then material on the standing authority continues on page 4.14. And please be aware of that material, read through it, and then we can see the permitted transactions if we do have a standing authority that the client has given us. Now, that material is pretty detailed. The best way to cover it, read through it. It's not going to make 100% sense immediately. Read through it again and do the practice questions that relate to client securities rules. It can come up in the exam, but having said that, I wouldn't become entirely bogged down with it. Be aware of the main points, but I wouldn't become an expert on the client securities rules, but be aware of some of the details. Client money rules, very similar to client security rules, in that they're protecting client money that's held by the licensed corporation. Again, major point is it only applies to client money held in Hong Kong. Another major point is client money must be held in segregated accounts. You cannot hold it in your intermediary's own bank account. It must be separated, a segregated account. A couple of sundry points at the bottom of page 4.15. Interest received on client money due to the client, unless otherwise agreed in writing, and money held in a segregated account, which you discover not to be client account, you must get it out of that account within 1 business day of discovery, and I have seen them examine that point. Moving on to the next set of rules, keeping of record rules. Now, this is a fancy way of saying you've got to keep accounts so that you know what is going on. The general requirements, well, you've got to have sufficient accounting, trading, and other records for a number of reasons which are listed under the general requirements. How should you keep records in Hong Kong? They should be in Chinese or English. How long should we keep the records for? The default is 7 years. However, anything that's close to a transaction that records detail as opposed to a summary, you keep for 2 years. Daily statement of account, the records documenting orders, contract notes, 2 years, everything else, 7 years. Now, offences. Not every set of rules is given the offences, but these offences or the breaches and what can result apply to all the rules. And we're told the breach of the rules without a reasonable excuse will attract penalties, including a fine. If a breach is committed with the intent to defraud, if fraud is involved, then it will be criminal and imprisonment. You can be whisked off to jail. Continuing the next set of rules, contract note, statement of account and receipt rules. And you will see that these do not apply to professional investors, whoever they are. And we'll outline that in topic 5, but there's a couple of points with regard to applicability to professional investors. Now we have details on contract notes, what you must do, when you must issue them, and what the contract note must contain. Now I want to make a distinction between daily statement of account and monthly statement of account. That's 6.2 versus 6.3. A daily statement of account is required to be issued if your client is involved in trading on the margin or receiving loans so that they can trade on the margin. What's that about? Well, I'm a client. I want to trade listed securities. I borrow money from either a financier or my dealer, and I provide the securities as collateral. If your client is involved in the margin trading or receiving margin, you must issue a daily statement of account showing the market value of the investments as opposed to the amount that has been lent. Whereas monthly statement of account 6.3 is for all clients, and we'll give details as listed. We've also under 6.21 and 6.22 given details of statements that should be issued when you are dealing with securities margin finance. That is 6.21 where you're providing the finance, and 6.22 where your client is actually trading on the margin. That is fairly detailed. Have a look at it, but it's certainly not examined every exam, so I'd take a cursory look. Also, receipts 6.4. Receipts should be issued by an intermediary or sussed entity when you receive client assets security by the end of second business day, T+2. Now, you must provide daily statements by the end of the second business day. You must supply monthly statements within 7 business days. It's listed in the detail there. It's actually 10 business days for portfolio managers, and T+2, that is by the end of the second business day for receipts under 6.4. And then the last set of rules that we're going to look at under topic 4, the accounts and audit rules. These are old, you can tell by the terminology. And these rules give details of the financial statements that should be prepared by intermediaries. Profit and loss account, balance sheet, notes of the accounts, and also supplementary information. And these rules also outline the requirements for the auditor's report. An auditor should give the normal, true and fair opinion with regard to the accounts of the licensed corporation, but also give an opinion on the applicability of the financial resource rules, keeping record rules, client security rules, and client money rules. Accounts and audit rules are not regularly examined, but the other rules, especially the first 3, financial resources, client securities, client money, often can appear in the exam. It's a bit daunting, all that detailed information. Should I know it all? Well, once again, I'm going to say that the best way to get it into your head is to do questions, possibly get them wrong, understand why you got them wrong, and that will help you accumulate the required short-term knowledge. And as ever, you should go to Examinator.online to do the required question practice.